Hey everybody, it's Justin with the Puri Group and DMA Real Estate. So it's a little bit late this month. I would like to get these monthly market updates out a little bit earlier, but I've been waiting on a few things coming in, some facts and figures coming in from various stakeholders out there. Now, in our May 2023 monthly market report, we're gonna have a little chat about prices, inventory, foreclosures, and the Federal Reserve's discussion on a possible recession. Now let's kick it off with prices. Now, home prices rose in the United States by approximately 1% in Q1 2023, which is a good indicator that there's a lot of pent-up mortgage demand despite a lot of affordability challenges out there. And according to a gentleman, his name's Doug Duncan, and he's at Fannie Mae, on a quarterly basis, home prices rose a seasonally adjusted 1% in Q1 of 2023. The fact that prices rose slightly in the first quarter is evidence of significant pent-up mortgage demand despite ongoing affordability constraints. So what that's telling us, and what I'm seeing and hearing from clients in the market, is that this time last year is when the interest rates started to escalate. Now, that's cool. We understood that was going on back then. But a lot of people re-sign 12-month leases. They're getting to the end of those leases, or will be in the next couple of months. And they're coming back to the market because they still don't want to be in that rental home. There's a lot of buyers that are new buyers because there's almost a year's worth of pent-up new buyers that are looking, that have kind of had enough of sitting around still living with their parents or whatever their living situation is. And there's a lot of people just coming back to the market because people need to live somewhere. So what that would tell me is that we are still in a seller's market because there is that low inventory. Now, in Q1, we did see some positive news with a slight increase in home prices. Now, this leads us to the question of whether home value declines have stabilized, which is a very important question for buyers too. Now, by examining leading indicators such as Case-Shiller, FHFA, and CoreLogic, we can argue that home prices may be stabilizing or have done so already. And looking at month-over-month prices since January of the previous year, we observed a strong start followed by a slight decrease in prices. And that was largely influenced by rising mortgage rates and other known factors, which is that housing price issue that we've seen for the last year. Now, recent data from FHFA, Case-Shiller, and CoreLogic, that indicates a positive turn in home prices, and the worst decline in home values are very likely behind us, and the prices are not plummeting dramatically. It's just not happening. Now, contrary to some predictions, the facts show that home price declines may not be as severe as anticipated. Now, Black Knight, just 5 months ago, were telling us that Black Knight's a financial institution, that prices were decreasing in 92% of US markets on a seasonally adjusted month-on-month basis. Now, seasonally adjusted, homes are more expensive in the summer because that's when the buyers come to the market. People like to move in the summer. If you want a deal on a house, you buy it at Christmas because nobody wants to move in the holidays. So that's the way that works. Same thing, if you want a pool, you buy it in the winter because it's cheaper. You don't make such stringent adjustments for a nice pool because nobody wants to buy a pool in the summer. If you want to get the most out of your pool, you sell it in the summer. So that's led to just an amazing turnaround, and home prices have shifted from declining in 92% of markets in February, and they've gone up they've actually begun to rise in 92% of markets in March. Now, it's great news for homeowners. And previously there were forecasts predicting a potential loss of over 4% in home values, but recent revisions from Fannie Mae, have caused or suggest a much lower estimate of about a 1% value loss, and it is anticipated that these positive trends will continue, and we may even see flat or positive growth in home prices due to various factors discussed previously. Now, it's important to note that actually we are already starting to see a growth again in prices, certainly in the markets I service down here in Southern California. The current lack of inventory is just a significant factor to this positive movement in home prices. I do want to kind of tie this into the conversation about foreclosures, which shows us that recent foreclosures have shed light on it, and it's important to understand that there's an ongoing imbalance in supply and demand. Now, the foreclosure issue, we'll get into it a little bit more shortly. We'll talk a little bit about inventory now, but it's all going to tie together as we go. Now, the current state of inventory that we're seeing can be observed by looking at the months of inventory for sale in the United States since the late 90s. And after the 2008 crisis, inventory increased, creating a buyer's market, which is, the way a buyer's market works. There's more homes for sale than there are buyers. Now, this, in recent years, we've been experiencing a seller's market, which is persisting today. There's not enough homes for the amount of buyers that we've got out there. And it's crucial to note that more inventory is needed as homes that are priced appropriately sell quickly. And that's everywhere nationwide. Now, despite claims of an impending surge in foreclosures leading to increased inventory, a report by ATTOM, A-T-T-O-M, in mid-April entitled US Foreclosure Activity Continues to Climb in Q1 of this year, that suggests otherwise. I'm going to stick some quotes down in the stuff below this video, so take a look at it. Now, while it is true that foreclosures are increasing, the headlines can be often misleading, and this may create the impression that more of us are at risk of losing our homes. However, it is essential to consider some relevant facts, and in the past year, there have been over 1 million fewer foreclosures compared to the average leading up to 2020. Now, to gain a better understanding of that, it's important to compare the current situation with the years 2017, 2018, 2019, which were relatively stable in terms of foreclosures, and they averaged around about 600,000 foreclosures a year. Now, they are an unfortunate reality in this business, and the numbers dropped significantly in 2020, 2021 and 2022, mostly due to the COVID moratoriums. Now, as those moratoriums are lifted, we can expect foreclosures to increase, but not to the extent that it will dramatically impact inventory and shift us into a buyer's market. Now, this graphic that I'm putting on the screen now illustrates US properties with foreclosure filings dating back to 2005, highlighted a peak during the 2008 housing crisis when over 9 million distressed properties were foreclosed upon, and that just caused a massive impact and distress across the whole nation. And believe it or not, we felt we had the same thing go on in the UK. Not to the same degree, but there's not 9 million homes, I don't think. Right now, foreclosure numbers, although they show a slight increase, it's not as alarming as the headlines make it out to be. And it's crucial to have some facts and understand exactly what the foreclosure activity is doing and why it's not as drastic as portrayed. Now, in the first quarter of this year, there were nearly 96,000 properties with filings, and 65 and some change initiated a foreclosure process. 65,000 and some change. So it's almost, there's some clarity amongst all these fear-inducing headlines. And I think Realtor.com, which is originally it was owned by NAR, the National Association of Realtors, so our governing body is Realtors. And our place, definitely one of the places I go for facts and figures and information about what's going on. So Realtor.com is still very closely tied to them. It's important to understand that when they say something, it's pretty on the nose, and they said it this time through Realtor. They summarized it pretty well, and they stated that there is no reason to panic yet, and foreclosure filings began to rise after the federal moratorium ended, which was implemented during the early days of COVID, and that was just to prevent widespread property loss due to job losses. So it makes a lot of sense. Now, that brings us on to the topic of forbearance programs, which are obviously the other part of the moratorium. And forbearance programs did serve their purpose during COVID-19, and they did provide a means for people to navigate financial challenges. While we can anticipate an increase in foreclosures, compared to last year, it will not reach a level that will result in a widespread loss of property. This is not 2008. And it's important that that is understood, and the fear mongering, understanding gets rid of the fear mongering, understanding dispels the fear, and we're just not in that market, so you don't have to worry about that. Now, recessions, and let's talk about that. The discussion of a potential recession is expected to intensify throughout this year, And the economy has been slowing down, with the Federal Reserve taking measures to control its pace. And I don't want to speculate on this because I'm not a financial analyst, but I do have enough exposure to this, and I do understand kind of what's going on. This isn't primarily what I do, and I do deal with it as part of what I do, but this isn't my expertise. But I think the exact timing, duration, or impact of a recession, they're not something I'm going to comment on, but it's important to acknowledge that talk of a recession is going to persist for a little while, and the Federal Reserve summary of their March meeting, which is released in April, that indicated their projection of a mild recession starting later this year, followed by a recovery over the next 2 years, is very likely. And we consider this information, it's important to understand the definition of recession and how it might impact the housing market. And I'm going to use NBER, which is the National Bureau of Economic Research's definition, and it describes it as a significant decline in economic activity that affects the entire economy and lasts for more than a few months. That's important. Now, while there is a common belief that 2 consecutive quarters of negative GDP define a recession, this definition takes into account various economic indicators. There is a crucial question that remains though, and how would a recession impact the housing market? That's what we're really interested in, right? Now, it's important that we do understand how it's going to affect housing prices, mortgage rates, and specifically interest rates and mortgage rates, and how that's going to affect you. And during a traditional recession, housing is generally impacted in some of a few ways, but bank rate, I think, say it really well, which is during a traditional recession, the Fed will usually lower interest rates. This creates an incentive for people to spend money and stimulate the economy. It also typically leads to more affordable mortgage rates, which leads to more opportunities for home buyers. Believe it or not, a lot of people buy homes during a recession. And this means that a recession can result in lower interest rates and more affordable mortgage rates, providing opportunities for home buyers. But it's kind of important to understand that not everybody's going to be in that position. And it's important to note that recession is generally associated with economic downturn, and it's not desirable for the country's overall well-being. We're also not going to see those 2% rates again. They're gone. Like that was a unique situation during COVID. It's never going to. One day I hope I eat my hat and everybody gets to buy a house on 2% mortgage rates, but it's not likely. Now, buying a home during a recession, it can have pros and cons. And as noted in the bank rate quote we talked about a little bit ago, the pros include potential advantages such as less competition, lower prices, and lower interest rates. However, there are also cons to consider, such as stricter lending requirements, fewer available options, and increased economic uncertainty. Now, it's crucial for us to understand that this could potentially be a risk going into this, but it's also a great time to do it if you manage and mitigate those risks correctly. Now, contrary to common belief, a recession doesn't automatically result in falling home prices or a housing crisis. In fact, I've got a research team that look at this. Some of my guys do a lot of this compiling of stuff for me, and then we review it and we come to these videos. And during the last 6 recessions, 4 out of 6 times home prices actually appreciated. Now, there are 2 instances of depreciation, and one of them was a marginal decline in the early 90s, but we understand that was, because of the financial situation then. And the most memorable downturn was in 2008, but that was all to do with the fact that people were losing so many homes, and there was such just a problem economically. Those recessions were very, very different, and 2008 actually resulted in a 20% loss of value. Now, that is going to cause significant hardship for anybody, and it does serve as a reminder that the impact a housing downturn can have is just massive, especially for those of us that saw our parents and loved ones struggle through that time. Definitely, I grew up in a household where my father was self-employed and owned a business, and it was a construction business, and it tanked in the 90s. It was terrible. don't know what happened in 2008. I'd already left home. I had a real job by then. Well, if you call the military a real job, I guess. We don't. So yeah, that's kind of important to understand. Now, it's kind of, I want to talk about the word recession in our country, and it brings to mind a significant downturn in 2008. That's like what people hear. If you say recession, they go 2008. It's crucial that we address those concerns. I think we need to understand that there's a lot of information banging around, and it does typically lead to falling prices, falling interest rates, and as far back as the 80s, the trends of recessions have been as expected, but the two most recent ones in the 90s and in 2008 just haven't. And it's important to understand that they were very unique economic circumstances, and that it's just not likely to happen that way. Now, as we move forward into the summer, it's essential for us to be prepared with that. And if we want to talk about it a little more, please, I can talk about this all day. I love it. But it's definitely a discussion that we have to understand and mitigate any issues you may have with it in the first place. Now, the current housing market, just to kind of dispel any issues that we might have about thinking it's like 2008, it's incredibly robust. It's very, very solid, and there's a lot of people with a lot of equity in their homes. So it's not like 2008 in that many people were 100% mortgages or owed more than the home was worth, which is why a lot of people lost their homes. Now, this is probably the strongest housing market that we will ever see in our lifetimes, and there's two compelling reasons to support that claim. Firstly, FHFA, as the fourth quarter last year, the majority of existing mortgages actually had an interest rate below 5%. That was those COVID rates, right? And below this threshold, 80% had below that threshold, and over 50% were below 4%. So 50% were mortgages of less than 4%, which is outrageous. And those loans are incredibly unlikely to default. Excuse me, my mouth's getting dry. Now, as homeowners are determined to keep those mortgage payments, I understand that renting an apartment would often seem more cost effective, but that just doesn't pencil out in the long run. Secondly, Americans have substantial equity in their homes, and this is what I just mentioned, and approximately kind of 67-68% of homeowners have either fully paid off their mortgage or possess at least 50% equity. So they're 50% or better equity in their home. So if they own $1 million home, they own $500,000 of it, and they only owe $500,000. So to break that down further, about 39% of individuals in the country own their home outright without any mortgage debt, and that it just indicates a significant level of financial stability and ownership security here in the United States in general, California especially. Now, around 29% of homeowners have that 50% equity, which makes them equity rich. When you combine this with the 39% who own their homes outright or have fully paid them off, you have just an astonishing number of like 68% who are in a strong position with housing, and that is a significant contrast to 2008 when people were just walking away. Nobody's going to walk away from $680,000 in a $1 million home, or $500,000 in a $1 million home. Now, the recent crisis and challenges we've faced, especially during COVID-19, have prompted a shift in mindset, and homeowners have recognized the importance of safeguarding equity. They're determined to do things different, and they want to protect their investment, and this change of behavior is contributing to the construction of an exceptionally solid foundation for a current housing market. That's why people aren't getting out of these homes. Now, the purpose of me emphasizing the strength of the housing market is to counteract those negative headlines that we've been talking about, and I think it rounds this out very nicely, and it gives you some facts about what is actually happening. I don't do negative Nelly headlines. I don't do fake news. I don't do any of that either. I just want everybody to be totally informed about what's going on and be able to make confident, robust decisions, and we are in the housing market that will let you do that. Now, while we may not have broader control or control over external factors in our economy can certainly, you know, we can definitely have control of what's going on with our houses, right? And before I just wrap this up, I just want to express I appreciate everybody joining me for this market report. And you know, the purpose of our market report is it's driven by a couple of key reasons. And firstly, you know, I want to keep everybody informed and confident and able to make, you know, good, knowledgeable decisions. And secondly, I want to offer you the most up-to-date and reliable housing market insights I can. And it's always truth-based. We do facts and figures. We don't do anything else here. And you know, I exist as purely as an expert in my field to be here to give you that advice. And I hope this information is very good. I hope it dispels a lot of problems or issues you may be encountering. And I look forward to having conversations with you. If you have got any questions about anything that we've talked about, feel free to give me a call. All my contact details are going to be below the video. Definitely would like to, you know, connect with you if there's anything you want to talk about. And I look forward to meeting with you soon. And the next video will be out in probably a month, probably a little bit earlier in the month, because again, we were waiting for a few things. Pending, we have got for next month is going to be the national debt and whether we decide to default on it, which is going to have a massive effect. So stand by for that. Okay, everybody, thanks so much for your time. Talk to you soon.